Well, good afternoon, everybody. I'm so glad that you could join us today. My name is Nancy Easterbrook. I'm Executive Director of Silicon Valley Directors Exchange. Welcome to our webinar today, especially after a long weekend. I'm so glad that you could join us. So we had a lot of debate about what to title this session, and we felt like we really are on a roller coaster when it comes to all of these banking issues. And so we felt like that was an appropriate title for what we're going to be talking about for the next hour. I'm sure there's been a lot of highs and lows for everybody. Maybe some of the more thrill seekers feel like more lows than highs, but we are looking forward to a really great discussion today. So we encourage you to go to our website to check out some of our past webinars. Today's session will be 60 minutes in length. We will be recording the session, and we encourage you to submit your questions through the Q&A feature on Zoom throughout the session. Please don't wait until the end. We like to fold them in throughout the discussion today. It's really my pleasure to introduce our speakers for today. I'm just going to give very short intros so that we can really get to the discussion of today's webinar. Ryan Donovan is President and CEO of the Council of Federal Home Loan Banks. He was previously Executive VP and Chief Advocacy Officer at the Credit Union National Association. Maureen Farrell is a business reporter at the New York Times, where she covers a wide-ranging beat that includes private equity, hedge fund bits for the Wall Street. And I will also make a plug for her wonderful book that she wrote a couple years ago called The Cult of We. I highly recommend it. Our moderator for today, Dan Siciliano, is a successful technology CEO founder, an entrepreneur, and recognized expert in corporate strategy and governance. He is vice chair of the board of the Federal Home Loan Bank of San Francisco and currently chairman of SVDX, board member of the Latino Corporate Directors Education Foundation, chair of the Council of Federal Home Loan Banks, and a fellow at Stanford University. Thank you again to our speakers today, and thanks to all of you for joining us. Dan, I'll let you take it away.
Great. Thanks very much, Nancy. And thanks, Maureen and Ryan, for taking the time for today's webinar. We could cover, lots of different topics, but we've kind of centered in on a few things that hopefully will be productive, and we'll take some questions from folks who hop on as well. I think my opening question, and we'll try to make this conversational, but my opening question is one that I think is very hotly debated, and I don't even quite know what your answers will be, unlike a lot of the other questions. And it is simply, where do you think we are now in terms of this banking situation? I don't want to lead by saying crisis. I'm not sure it's a crisis. I'd be interested in your thought, but where are we now? Are things more stable and getting better, not stable but getting better, stable but getting worse, or some other permutation of that? Where do you think we are at this moment? Maureen, do you mind going first? I'll have you kind of kick it off.
I'll start. I mean, it does feel fairly stable at this exact moment and fairly contained. That said, I mean, did any of us have any idea that SVB would play out as it did? I mean, it was not on anybody's radar, not the CEOs, not regulators, or barely, of SVB. And it came so quickly. So I don't doubt that there's some other thing could flip people out again. I don't think it's everything's been is really safer, that something else couldn't create an issue in the system. But I do feel like right now there doesn't seem to be anything lurking immediately. This crisis or whatever it was does seem contained.
That is happily reassuring, by the way, reassuring. So Ryan, before I have you join in, I want to do a quick follow-up for Maureen about the surprise factor of Silicon Valley Bank. And I think we need to emphasize to people your background, right? I mean, you started out covering kind of debt security stuff, then you were at CNN Money, then you're at the Wall Street Journal, now you're at New York Times. So you are a seasoned journalist who kind of has been at the front line of all the stuff that's worth noting in the last decade and a half and more. How surprised were you? Because I would consider you kind of very in the flow. You make a living talking to people about what's happening, what's newsworthy, what's interesting. How surprised were you by the emergence of the Silicon Valley Bank crisis, and then kind of related, but it's sort of a separate question, by its speed?
Oh, incredibly surprised. I mean, as you said, I've covered all sorts of things in the around Wall Street for a long time, but most recently, before coming to the Times, my real focus was on IPOs and capital markets. So, I mean, this is like a debt capital market situation. I mean, they were selling the debt of Silicon Valley Bank at a discount. There was like a real, issue with its loan book, or selling these loans that it had. And I basically, it was a pretty large sale. The markets have been pretty quiet. I don't cover that area as closely, but I think the morning that after they had sold their loans at a big discount, and they were like, it was, maybe 11 o'clock. I was talking to some people in Silicon Valley. They're like, this looks really scary. You might remember they announced that they had sold these, and then the stock started to tank, and then things were sort of reverberating really quickly in WhatsApp groups, people starting to say to take your money out. But I mean, it really came out of nowhere, it felt like. So no, I was completely ill prepared, as it seemed everyone was. I mean, it just had not been and bank that people liked, not the most exciting bank to cover ever, but in the epicenter. And then, I mean, the magnitude and just how scary it was very quickly became apparent when you started talking, by Friday, this was on Thursday, if I'm remembering correctly. Friday, it was like people's accounts were just locked up, big companies, medium size, small, people weren't going to get paid. So yeah, the speed was just, I mean, unlike anything I think any of us have seen before.
Great. And I appreciate that. And again, you're kind of in the know, sophisticated, and in the flow of information, like arguably kind of. So we'll come back to that. I think it'll be kind of relevant. But Ryan, I want to give you a chance to let us know where we are now and what do you think. And I'll kind of remind everyone, you bring a pretty strong policy bent. I mean, you spent a career at the credit union association, really bringing credit unions from already successful key players at community level for groups small and sometimes large, to genuinely equal players in the ecosystem for financial services in the United States, right? And so that change is a big change. So I hope that you'll bring kind of a policy lens to a lot of stuff. Not that we don't mind you weighing in on the macro stuff if you like, but kind of the policy lens is what I'm hoping for. So
no, I appreciate that. Yeah, I appreciate that, Dan. I also spent about a decade on Capitol Hill as a staffer on Financial Services Committee, and so I do sort of look at this perhaps a little differently, and am paying a bit of attention to how policymakers are responding. But I agree with Maureen. I think that stable and contained are good adjectives to describe where we are right now. But my concern would be that I'm not sure the underlying vulnerabilities have really been addressed, right? So things did happen fast, but there's been no change in policy. There's been no sort of circuit breaker that's been put into place that keeps something like this from happening again in the future. So we didn't know this was going to happen, and happened very quickly. And I guess I worry that there could be others out there that face similar sensitivities, vulnerabilities, and we may not be able to see those. Congress is been looking into this, but I think they are sensitive to those same vulnerabilities, right? When we've talked to folks on the Hill, you've certainly seen hearings and things of that, but you haven't seen the type of legislative scrutiny that you saw in the great financial crisis, or even going back further to Enron and those types of issues, in large part because the legislature doesn't want to spook the market again. You shine too much light on this, you have too much scrutiny, and you run the risk, I think, of undermining what confidence there is in the banking system right now. So stable, contained, but still vulnerable would be how I would describe it.
Great. Well, you kind of opened the door, I think, by saying that looking at these banks, and not as much scrutiny as during the great financial crisis, but still some scrutiny. And I think a lot of the conversation has been around differentiating or not, right, to your earlier point, differentiating the kind of characteristics and qualities or defects of Silicon Valley Bank, First Republic, Signature. And I wonder if, and Ryan, maybe we start with you a little bit, kind of at a big picture level. I'm also interested in kind of the power dynamic, how much weight they carried, on the Hill with regulators, if you have an impression about that. But what was different and the same, maybe among themselves, but also with all these other regional banks. Now, and I'll kind of set it up a little bit, which is to say, there's some great academic papers that came out shortly after Silicon Valley Bank, before First Republic, but it was after Signature and Silicon Valley. And they went something like, listen, this is at least in part a function of interest rate risk and exposure. And there are lots of banks, well-run banks otherwise, that have, exposure to this problem. They've been buying high quality, mortgage-backed securities, government notes, et cetera, but they did so in a low rate environment. And they did so of varying durations, 1 year, 5 year, 10 years sometimes. And now here we are in a dramatically higher, maybe surprise to some, higher rate environment. And they have what we would call kind of mark to market versus hold to maturity problem. And again, just as a briefing, because I know we have some very sophisticated and some less sophisticated people on the webinar, but if you have something in the oversimplifying, so those who are experts, forgive me, in the hold to maturity bucket, you don't necessarily, in accounting wise, you certainly don't have to mark it for its present discounted value. Meaning if interest rates went up, it probably is worth less on its face. If on the other hand, it is put into, or you have to put it into the, available for sale category, then you're going to have to, if you sell it, it's going to get discounted, or if you have to market to market, it's going to be worth a lot less. So that problem permeates the banking system broadly, and even the Fed, right? Like if you held the Fed to the same standard, the Fed's balance sheet, suffers a lot too. It's because risk-free rate has gone way up. So with that as a backdrop, how different or how similar are these failed banks to each other versus the ecosystem as a whole? And then Maureen, I'll have you answer that as well. But Ryan, I wonder if you can go first.
So I haven't looked closely at each of the banks, but I do think that the similarity is their susceptibility to the contagion, right? So if you view this episode perhaps as a virus, and it might not have even started at Silicon Valley Bank, it likely, Silvergate was just a little bit before then. It self-liquidated, but they were susceptible for all the reasons that you laid out to this contagion running through them. So you could have we've just all been through this pandemic. You have patients with different underlying conditions affected differently by this virus, and in this case, all three of these banks were susceptible to the same thing.
And I'd say, what you do notice pretty quickly about all three of these banks they were very much outliers. Like, you could, as you mentioned, Dan, like you look and things are underwater right now. Interest rates have gone up. The way, if you were to mark everything to market right now, you'd see a lot of losses at banks. But in terms of when we looked at SVB, I don't remember the exact number, but it was such an extreme outlier in terms of the loans that it put in the held to maturity bucket. If I remember right, it was something like 80%, and on average, it was like 40 to 50% for a bank. It was so far extreme, and and then the concentration of customers, both at SVB, First Republic, and Signature, they had very concentrated customers. And it's interesting. I'll just take First Republic quickly as an example. I went back through their conference calls, everything else. You listen to the chairman, former CEO, founder, and even the newer CEO, and basically it's safe. We have the safest customers. They had customers that were giving mortgages, lower interest rate mortgages, primarily to a very wealthy group of clients. And there was almost, as opposed to the financial crisis, it wasn't like they were making risky loans or offering risky mortgages to them. They were going to pay them back. It was just that interest rates rose, but they had a sort of concentrated group of customers, and then they got deposits by giving those mortgages to people. So that concentrated group of customers were among the first to flee at any sign of trouble. So it was just a very different paradigm of what was safe, what was risky, that they were sort of accounting for at the time. But again, I think all three of these banks, and maybe there's a couple of others now, were outliers. They don't necessarily look like the broad, like regional banks in general. When you look at some of these, if you look at some of this criteria, like whether it's held to maturity or the type of concentration of customers.
No, that's great. I think that's very helpful. And I'm looking at some of the questions coming through the queue and maybe trying to weave those in. So just to recap, one of the interesting observations is that it wasn't so much whether or not these banks had certain issues that were common to others. It's just that when they did have those issues, they were kind of perhaps exaggerated or extraordinary or more acute than others. So the outlier idea that you highlighted. And so I think you highlighted, the interest rate exposure, which in this case was the percentage of the portfolio in held to maturity, leaves the possibility of it being recharacterized, and hence that's going to be if you had only 5%, say, of all your securities in held to maturity, and you had to mark them all, well, that's going to move the needle a lot less than if you had to say, had 80%. So that makes sense, and I think that's an answer in part. But I want to pose this question specifically. Most of these items and data points were publicly disclosed. So all the banks we're talking about were publicly traded, and that's its own issue, which we might get to. I have some questions about how you think that plays in, in the stock market and social media and the like. But before we get to that, insofar as these disclosures were, accurate, and I don't think anyone's arguing or suggested that there are inaccuracies in the disclosures, and most of these items were public, why then, what is your theory behind the surprise? And by the way, Maureen, you are an exceptionally good company in being surprised, right? I mean, almost everyone says they were surprised. And yet it's a great question. I think, we got it posed a couple times. Why, if everything's publicly disclosed, are people surprised in these circumstances, including regulators, right, to a certain extent? What's our thinking about the why on that? What do you think?
I mean, Ryan, I'd love to hear what you think from a regulatory one first, then I can weigh in.
Okay, let's do regulatory first. Yeah, right.
Yeah. Listen, the way that Congress is looking at this is really in three ways. It's what were the supervisory failures, what were the management failures, and what was the role of regulation? And the role of regulation is really sort of a political discussion right now, where Democrats writ large are taking Republicans to task for rolling back regulations in the last administration. But you really had this perfect storm of a supervisory failure within the banks. Some of the banks had, as I understand it, examiners in-house that were supposed to be looking at this, and then the management failures, famously SVB not having a chief risk officer, although the CEO has testified before Congress multiple times that, well, just because we didn't have a chief risk officer doesn't mean that we didn't have a chief risk function. But I think it was a surprise because of no one expected the technology, the internet discussion, the WhatsApp discussions to fuel such a fast runoff. So the surprise wasn't in the disclosures, in my view. The surprise was in the customer reaction and the speed with which that was taken.
That's great. And Maureen, I'm happy to have you give a de novo answer to my question, but I would love for you to pick up on this technology differentiator between, say, 2008 and 2011. We had lots of bank failures. They happened in a very different speed, a very different pattern. I think a lot has been said about the technology environment contributing not to the surprise, as you point out, Ryan, but to the most surprising part for most people, which is the speed at which Silicon Valley Bank in particular happened. Can you expand on that as to your thoughts?
Sure. I mean, so in the financial crisis, there were concerns about, real concerns about every big bank, and a lot of them were really on the brink, but you didn't see, it wasn't like people were lining up at banks either online or in person to pull their money out. It was just such a different idea or possibility. I mean, now you could push a few buttons and transfer all your money out very quickly. So I think the technology makes it very easy to do so. And I think just the speed, it was these WhatsApp app groups you hear, and Twitter and everything else, just the information just spread so quickly, and people could just go on unbelievably quickly and move things around. Plus, I mean, we have these deposit caps. I mean, there's a real fear you're going to lose, not have access to your money. And I mean, clearly both Silicon Valley Bank and First Republic and Signature, I think a lot of their clients were well over those caps. So, I mean, all of that just like fed into itself. But yeah, it wasn't the same push of a button, though also people were literally lining up at these banks. I mean, that was happening in those days too.
So it's interesting. I think, again, to recap, Silicon Valley Bank had 90+% of its deposits were uninsured, right? That doesn't mean 90% of its customers had uninsured deposits, but as an aggregate total of overall deposits. In fact, it was closer to 95, 96%. It was really quite an extraordinary number, depending how you slice it. But above 90% puts it as a very, like a 2 or 3 standard deviation outlier. And as it turns out, First Republic also had a very high, though not nearly as high, percentage of uninsured deposits, which maybe brings that into focus. And Ryan, I want to turn this technology question back to you a little bit, which is about, thinking at the policy congressional level. Arguably, I'm maybe asking you to look in your crystal ball and say what might be done. But just to put a finer point on it, by Thursday morning of the Silicon Valley Bank crisis, that morning, if you go and look, you can find well-made TikTok videos that were absolutely panic-inducing to an average person, right? Like they would, and if you know TikTok at all, most of us aren't allowed to have it installed on any of our devices, but like if you have TikTok at all, or if you've seen it, or if you have a teenage child, yeah, you will realize that, they're often set to music. Sometimes the music's irrelevant. Sometimes it's really well produced, and they've done a good selection, and there's dramatic sound effects, kind of Kramer-ish, right? Like, the big buzzers and whatnot. And it is quite stunning to look at the number of TikToks and WhatsApp chats that were just, circulating. And so the question for you, Ryan, is this feels like a new era with a new contagion vector that just hasn't been there before. And, we've been trying to, when I say we, those of us who chat about it at Stanford, to call this a meme run, not a bank sprint, which I don't like as much, but a meme run. If you know what a meme is, you see it, and in 2 seconds, you either get it or you don't, and you do or you don't react. And that was Silicon Valley Bank. You got a panicky something, and you said to yourself, I've got some uninsured deposits. Let me move my money. And 30 seconds later it was done. That's not running. That's like immediately responding. So how well equipped are the agencies, Congress, others to really dissect this, right? Like, I don't know what the survey would show, but I bet if you ask most Congress people, hey, what's medium.com? Do you know what a Substack is? And have you ever seen anything on Reddit? I suspect the percentages are going to be really low, right? As to that understanding.
Yeah, Dan, as I've been listening to you ask the question, I've been trying to figure out how to put diplomatically my level of confidence in Congress to deal with a technology issue, right? But I'm not sure this is a technology issue. Sure, it is, exacerbated by technology, but it isn't like we just woke up in 2023 and we had our first bank run ever, right? I mean, there are laws on the books against undermining the confidence of federally insured financial institutions, right? So, I don't know that there's going to be a law enforcement component to the meme run or the TikTok videos, but certainly that it's improper to use your speech to cause the failure of a bank. I do think that the sort of ironic twist on this at the end of the day is that that depositors in general are probably going to be better off at the end of this. And the reason that I think that is I have not, in my 30 years of working in Congress and around these issues, never seen Congress not respond to something like this. There's certainly a little political pressure to do so. And I just think at the end of the day, one of the responses will likely be around ensuring confidence in the vast majority of deposits in banks across the country. I'm not saying that they're going to do unlimited deposit insurance or even raise the cap, but there has been talk about providing greater insurance on transaction accounts. And certainly coming out of the financial crisis, that was something that Congress did on a temporary basis. And I've been scratching my head trying to remember why they allowed that to sunset, but it was probably a political consideration. And I just think that is probably one of the things that will happen coming out of this to keep something like this from happening again, which I think was ultimately a crisis of confidence. And so Congress's role at this point, I think, is to make sure that they can maintain the confidence in the next crisis.
Well, Ryan, this marks you as an officially encouraging optimist at heart. So you've just outlined both a silver lining and said that it'll be brought to us by Congress. So like if anyone ever calls you a pessimist, it's just not true. Which I actually appreciate that.
Cynic, I guess.
I appreciate that, and I think history more or less demonstrates what you identified. And let me pivot this into a related question about where we're going in terms of what's happening right now in terms of the agencies and congressional past acts and like. So to clarify what you were talking about, this idea of non-interest bearing transactions accounts, which are kind of business accounts that are operated by small, medium, large businesses, and they can go from many millions to like $800 and then up again because they're, this is where payroll flows through, and very few people are kind of shopping around for interest rates on that. You tend to be, well, first of all, in the last few years, no interest rate, so zero, and no toasters were involved, so people aren't being induced to come to some, weird bank or anything for that. And there's a great compelling argument that says like the really panicky folks that you don't want to panic are CFOs who think they won't be able to execute payroll on Friday because things are falling apart, which, by the way, my CFO at the fintech that I run, Nickel, we were, full disclosure, clients at Silicon Valley Bank, and that was the panic he was having. So the solution to a great financial crisis, the FDIC had the power to invoke, full insurance of that type of account. They did so. Dodd-Frank, oddly, stripped the power from the FDIC, but extended it another 2 years. FDIC did 2 years and Congress extended it for 2 years, but kept the power for themselves. So the FDIC doesn't have the power at the moment to do that. And yet, it's a little bit confusing. So with that in mind, my question for you, Maureen, and then Ryan, certainly feel free to hop in. We've gotten a bunch of questions before the webinar, during the webinar, that go something like, okay, we're smart business people. We have this company, that company. We were at Silicon Valley Bank and this other bank. Then we moved and got caught in that. And then we moved to here. Now we're at, name a bank that's, on the watch list. What are we to do? And then they went on, and there's some strategies in answer to one of the questions. Most banks offer, many banks, regional banks offer a form of overnight split deposit insurance. It goes by different names. Sometimes it's CD related, sometimes it's money market related. But in short, they have a relationship through a third party that organizes their deposits and overnight ships them at $250,000 increments, to other banks so that they're FDIC insured, and then pulls them back. And it's a pretty sound way to create a higher limit for insurance. So people are aware of that, but they still have this feeling that it feels like the only thing that's prudent at this point is go to a GSIB, to go to one of the big banks where I should go. We see this question enough that I think it's a legitimate point where this lack of, non-interest bearing unlimited insurance, the general anxiety that I think prudent people have, and this concern that only the big banks would survive a calamity, whether or not we face one, where is it going? And my follow-up is going to be more about regional banks and the role they play. But where do you feel that's going, Maureen? And what is a reasonable answer to someone who runs a business that has $50 million of annual revenues and payroll accounts that are 2 or 3 million in any given cycle? And we're not talking big rollers here, right? But we're talking about a business that matters. What should they do? Sorry, there's like 4 questions buried in there. Pick and choose how you like.
Sure. First of all, dicey taking any financial advice from me or me offering any. But I guess, it's obviously the first job of the CFO of any company is like, you don't want to like have your accounts inaccessible. But it's interesting. I mean, I'll start by saying this is all somewhat speculative, but a couple of things. I mean, we've already had this situation that the big banks are getting bigger, since Silicon Valley and First Republic. JP Morgan now owns First Republic. That's not an outcome anyone's ever wanted. We've never wanted the big banks getting bigger. They are safer. So I think there's an idea that we want to save, like as a society, want to save regional banks. They're really critical engines of the economy. There's certain things that a regional bank can do that JP Morgan, Jamie Dimon's not going to say he wants to do or can do. Like he wants them in business. We all do. And we have a you know, there are things that they can see. And I think it's a huge loss, just anecdotally from what I've seen. It just seems like a really sad outcome with Silicon Valley Bank and First Republic. I mean, the stories people tell of the like true relationships that they had with these banks and the ways they were able to see things that a bigger bank probably couldn't or wouldn't even be allowed to, that weren't necessarily risky loans, but really were these people were partners in growing businesses in general. So we've you know, from what I've heard, it's just now there's like a level of like anonymity sometimes, I think, being a customer of a big bank in a way that people did not have. I mean, I had never had that experience, but when people are like, oh, I talked to my banker, even people like every single day, these were like even small, medium-sized businesses. They helped me find employees, or they did all these other services for me. So I think there's, whether it's Congress or regulators, they don't want to lose these regional banks. So in theory, there should be some safety that these are not going to just go up in smoke. But I don't know. I mean, this happened so quickly, and obviously you were protected one way or another, even though it was like kind of painful for a little bit and nerve-wracking. So I don't have a good answer. It's like, yes, at a GSIB, you're safe. But theoretically and like policy-wise, you should still be safe no matter what happens at a regional bank. But we don't really know this. I guess it's still a bit of a gamble.
Yeah, and in fact, I think it's one of those classic, almost tragedy of the commons, right? It's a public policy effect where a reasonable individual company thinks to themselves, the marginal risk isn't worth it to me, I'm going to go. And they've got all these trade-offs you just identified, customer service, attention. But there is a I suspect very few people on the webinar spend any time reading, you know, the current latest articles in banking theory, but there is a big set of very robust literature that says that regional and local, but they're different, you know, regional and local banks provide a super important function of sorting and sifting out like local needs and deploy capital in smart ways that are non-obvious. If you're a giant bank, you're just not going to slice and dice it 1,000 ways if you're Jamie Dimon. It doesn't make any sense. It doesn't scale. And so there's like a huge service to the economy that is performed by these banks. And this turns my question to you, Ryan. And I'm riffing off of two questions that we received so far that go something like, okay, so we lose Silicon Valley Bank, we lose First Republic Bank. Now, you can characterize them as catering to rich people and venture capitalists and all those, you know, shame on them. But at another level, they were First Republic Bank managing a complicated real estate market, right? That had unusual loan structures, handling unusual, you know, debt arrangements for productive things where people were buying, like in Northern California, there are actually a couple fabs left that do semiconductor work, heaven forbid, right? Like super specialized stuff. And then Silicon Valley Bank, of course, more knowledge about the entrepreneurial community in a way that very few people understood. And for those who don't care about the entrepreneurial community, the wine making industry, right? So all this specialized knowledge kind of obliterated in some ways, not 100% lost, but certainly a lot of it lost. Who replaces that? And what does that speak to these other regional banks? Regional banks have specialties, which now feels like a bit of a, you know, problem rather than a feature, right? Like, so regional banks might cater to, you know, retail, to agriculture in a certain space. So how do we sort out this regional bank function and risk, and what can be done to, like, it seems like that's one of the losers in our headline promise to everyone listening.
You know, a couple of thoughts come to my mind here. And, you know, I represented the credit union system for 15 years, and the credit union system, in order to be a member of a specific credit union, you have to qualify for membership. You can qualify for membership on a number of different ways, but it's generally being like the other people in the credit union, or the other members of the credit union, whether it's where you work, worship, where you live. And so there is an element of concentration there, and there's an element of a specialty that goes on there at a much smaller scale than what we're talking about. But it does lead me to believe that there may be an answer in some of these smaller banks in specific regions and in specific areas, right? Silicon Valley Bank surely wasn't the only bank catering to the wine industry. There are, you know, surely community banks throughout Sonoma, Napa, the Finger Lakes, in every wine community that understand that could be relevant to certain depositors and certain bank customers. I just, there may be a flight to safety into the larger banks, but I do think that there is a role for smaller banks to play in this, and that they do have an important role, and they can also specialize because they are specialized in the community that they serve.
So a follow-up question, and feel free to dodge this as necessary, Ryan, but it's kind of a pointed question, and it has to do, and I'm going to pick Senator Elizabeth Warren as a representative of a group of players who have a certain way of thinking, and that is, to hold the Silicon Valley banks and the First Republic banks and the Signature banks very much to account, which on its face, nothing wrong with that, but to hold them very much to account puts pressure on regional banks broadly, right? Because regional banks are harder to run and they have certain features and assets. Yeah. And yet in the winners and losers column, what's interesting is if you take out a regional bank or you really restrict its capacity to act, probably players like private equity show up, right? So non-depository institutions will often show up and provide capital in a somewhat alternative way. And it strikes me that in an overgeneralized way, this is not the redistribution of power that Senator Warren would want. And yet it seems like one of the likely paths of who wins, who loses. If you have fewer regional banks with less discretion, less credit, someone shows up to provide that capital, and it's not banking, it's not credit unions, so how does that dynamic play out? Or is that something that people are actively debating, do you think? And where does that go?
Yeah, I think it is. Listen, I think it is very safe to say that Elizabeth Warren is not happy with what has happened here, and that and not just what happened, but also the implications. If it leads to fewer regional banks and the large banks just keep getting larger, that is exactly the opposite of what she has professed through her public policy career, and really why she has gotten into Congress. And so I do think there will be, there's an incredible sensitivity on Capitol Hill, and you even saw it with the FDIC and the Biden administration in terms of making sure that the small banks, community banks, credit unions aren't impacted by this. That's why with the FDIC assessment that took place, they worked to limit that to just to the larger banks paying it. And there will be, I think, other actions that will be taken to make sure that nothing that happened with SVB, Signature, First Republic ends up adversely impacting small banks. That's not to say that the plight of small banks is an easy one, though. I mean, there's, the consolidation trend continues, and episodes like this just serve, I think, to probably accelerate it.
So that brings up kind of natural next question, which might be some of the debate itself around moral hazard and who gets bailed out and who doesn't get bailed out. And I wondered, maybe Maureen, you can take a run at this because I know you've written about it and thought a lot about it. In the hierarchy of moral hazard and or just winners and losers and what to think about the next time around, you create a different set of incentives. It feels like we have lots of different categories. Obviously, we've got depositors, right? But then we have shareholders and bondholders. And then you have, those who acquired the assets of the, failed institution. And so can you walk us through who you think, is at risk of being incentivized, maybe the wrong way? We have to be thoughtful about what we, give them as a bailout or not a bailout. And then I'll come back to like taxpayers. Where do taxpayers show up in this? But let's hold that for the last part. Maureen, go ahead.
I don't know about the moral hazard right now, because I think it seems like most people agree right now that there's not a true moral hazard with depositors. We've spoken about that. We have a financial system in which you should just assume there's some assumption. You shouldn't have to think really hard about your deposits being safe. Obviously, that was a question earlier you asked, Dan, and that other people have had, but that's a scary baseline for a system if everyone's constantly worried. And there's no moral hazard with a $50 million company. Like there's just, you cannot possibly break up every single account into under $250,000 like that. There's some sort of ridiculous thing there. Like the system should just be safe there. As far as shareholders, I mean, it's interesting. I don't know really if there's any specific moral hazard. I mean, the one thing we've seen, and I think they've paid the price to a certain extent, was, Silicon Valley Bank, in particular, we could say, they rode this wave of, they took in deposits, they just boomed, and their stocks surged, and their deposits surged as post-pandemic, and they were clearly not very responsible at all with how they managed it. So they were rewarded very much on the way up. And I've talked to other bank CEOs, and they say, yeah, it was frustrating. Like we couldn't do what they did, but there was a sense that it wasn't like necessarily the safest route, but they just raced ahead with it. I don't know if they're paying the price in some way. I mean, obviously they did very well on the way up. And a lot of other people are paying the price, but I don't think it's necessarily, and like you could say that JP Morgan or others might benefit who get to pick up these assets, but the banks are also taking a hit now because they have to pay this deposit insurance. So it's costly. It's not like, I think in some way there's not a clear, obvious moral hazard to anyone because people are paying the price. I mean, it's not to say the system is totally fair or makes sense in every way. And a lot of people dropped the ball, but it doesn't seem like anyone was rewarded in an outsized way for what they did or didn't do.
Well, Maureen, that actually means a lot coming from you and your perspective, right? If anyone's read your work and paid attention, I would say that you're an appropriately skeptical and hard-hitting, financial journalist, and where blame is appropriate, blame is applied. And to say that there's, no outlier moral hazard problem, which I think you're right. I think that's the general sentiment, I think is important because it sort of points to no easy fix. Like if it was all just a single moral hazard thing, you say, well, punish these folks and don't let them free ride in that way. But it's not that easy, I suspect, which sort of kind of brings me back around to Ryan in a way as a follow-up on that. And that is, what does that imply in terms of future fixes if you had to think about it? And I'd love for you to insert a little bit about the diversification that credit unions, because we've got a couple of questions about that credit unions bring to this story. The regulatory structures are a little different, but they're very parallel. Like the expectations tend to be parallel, the insurance levels tend to be parallel. And before I let you loose on that, I do want to point out, Maureen, you highlighted this idea of an expectation of safety and reliance for average people on the banking system. And for the lawyers in the crowd, we'll remember that once upon a time, it really was in the United States for consumers, caveat emptor, right? It's like, well, be careful about the bread you buy. Sometimes it has pointy needles in it and you just need to be more careful, right? And we evolved that over time to an expectation of a certain amount of safety and reliance, right? And I feel like banks, maybe it didn't matter because, 50 years ago, we were all so much poorer on average, right? We had a lot less wealth to store. So maybe that's a piece of it. But Ryan, back to you on this idea of where does that go and weave in credit unions for us?
Yeah, sure. So I think the first thing I'd want to say just in response to the questions is I think the thing that's troubled me the most about how we've talked about the regulatory response to SVB, the immediate regulatory response to SVB is that it's been characterized sometimes as a bailout. And I'm not sure anybody was bailed out. I know the shareholders weren't bailed out, right? And, if anybody was bailed out, it might have been the depositors, but that was wasn't as if money was transferred to them. They just got the money. It was guaranteed. And so I think I agree with Maureen in terms of the moral hazard question, except to say that there's no guarantee presently that the government will do again what they did with SVB, Signature, and First Republic and guarantee the deposits. I think that's a policy goal that Congress needs to get to and that they're working towards. It's not quite there yet. With respect to credit unions are a little bit isolated from this just because they have a separate safety and soundness regulator. separate deposit insurance fund, but the fundamentals are the same. And I'll share just from my previous time with them that liquidity risk and interest rate risk have been top risk factors for the National Credit Union Administration for at least the last 24 months, if not longer. I mean, that's what they have been in credit unions examining for, testing them on, is how they are mitigating those risks. It's not to say that they were in any way clairvoyant on the interest rate rises that the Fed has come to take over the last year or so, but it has been something that regulator has been, I think, a little bit ahead of for those institutions, and likely with good reason. Again, as I mentioned, there is some just natural concentration risk within the credit union system by virtue of how their membership is comprised. So, I think, to the question of how do they fit into this discussion, they are, similar entities to community banks. They're, isolated from the FDIC insurance fund, but they have a regulator that's been very much aware of and paying close attention to these risks.
Thank you. So we have about 10, 12 minutes left, and I want to pivot into a couple of questions that we got. We've covered most of the stuff that we set out to cover, but we would be remiss if we didn't at least mention commercial real estate as kind of the next thing that's worrying people and where to pay attention. And it ties nicely with this idea of regional banks, right? So we know regional and local banks, play a somewhat outsized role in this type of lending. Certainly not the major metro grouping of big, tall, fancy skyscrapers. That's really a different, structure and involves insurance companies and the like. But, strip malls, dentist office, hair salons, you name it. There's a lot of lending that occurs, and there's a strong sentiment, and it's increasing, it feels like, that the commercial real estate market is in for a bit of a rough time. Now, there's different segments. There's, warehouse, research, retail, et cetera. So certainly on the office segment, that seems to be a prevailing sentiment. Can you maybe talk to us a little bit about how you think that might play out and how that'll impact, regional banks versus other kinds of banks and the like? And Maureen, maybe you go first. I know you've been thinking about this a fair bit.
Sure. I mean, it's clear that there's, a ton of worry. You look at the stocks of the office space REITs, they've gotten crushed. And I think investors are clearly looking at who has the most exposure. And you hear stories of, you can walk around. I've been in New York, I haven't been to San Francisco as much recently, but you just see you hear horror stories in San Francisco. So it feels like it could be cataclysmic, clearly, but I just think it's a little bit soon, and it's unclear. As we spoke earlier about with the SVB, it came so out of nowhere. So I think it's almost the opposite. It's like there's a sense of impending doom in commercial real estate, but I don't know if anyone has a clear idea how it's going to play out, but they're bracing themselves for it, clearly selling out of office space REITs and other things, at least in the stock market. So yeah, I think it's still a bit of a question mark, though, a lot of fear for good reason.
Even before,
go ahead, Ryan. Yeah, go ahead.
Even before SVB, I was wondering why people weren't talking about this more, right? Why wasn't this being covered more? Again, I'll try to find the silver lining in this, is that this could very well be a slow burn, right? So, commercial real estate leases are generally office space leases, can be generally a little longer, and they aren't all going to reset at the same time. And so that could be helpful in sort of drawing out this so that it's not all coming down at the same time. But I'll say in DC, certainly the streets have gotten a little busier since the first of the year. But Fridays and Mondays are still somewhat of a ghost town in Washington.
I'd like to just now that we're talking about this, by the way, I think it's, as you mentioned, it's definitely being covered, it's being watched, but if anyone in the audience has anything I should be watching, please, you have my email or can find it easily. Fill me in on what I should be seeing, or if you know any stories of like pockets or anything I should be watching.
Well, and a good point to raise, Maureen, just based on the questions. I mean, I think people are really thinking about it quite a bit. And if you are in the Bay Area, I think your attention was drawn to 350 California, which, had a headline value and then sold for a lot less. And then interesting part of that was not a distress sale like that. One expects tremendous discounts in a distress sale. I'm reminded of something Sam Zell, who just recently passed away, said repeatedly whenever he would talk in front of business school students or law school students or anybody on campuses. He would always say, don't buy at auction and never hold a office space that's dated, right? Office building is dated. And so like if his words matter, I think there's a lot of attention drawn to that. So it feels like, let me just kind of sum up where we started and where we're ending. So one, stable and maybe improving, but lots of unknowns, right? And an acknowledgement that surprise can happen and that the regional bank conundrum is with us, right? We need them. They're in a tough spot. Natural inclination is to go to big banks. No one really wants that. Maybe not even the big banks, right? And yet it's underway. And so, with that as kind of the backdrop, and then these other things floating out there, we don't have to mention the other risk factors, but commercial real estate being one of them. It feels like you highlighted a couple potential things that Congress might do. Ryan, thank you for the optimism. That's good to have. And Maureen, kind of observation of what's done in the past. But maybe my parting question to you would be, if you had the ability to change one thing, if you're given the ever famous magic wand, and you could just say, this is different, what might it be? And I ask that question in part because it reveals some of your thinking to give context to your answers, but also, sometimes it helps focus us on something that maybe is non-obvious, but you think matters a bunch. So either of you can go first. Whoever wants to go first.
Let Maureen go. I've got one, but I'll let Maureen go first.
I don't necessarily have anything specific. I think I'll just say, and I mean, we all know this, you have more regulation can do positive things. And we saw that it was kind of scaled back at the smaller banks. But it's hard to tell. Would it have, saved SVB? Would it have, it's unclear because people maneuver around these regulations. So it's not a one size, there's no answer straightforward, I think, on that side. But I mean, enforcement of this, that just seems like the biggest issue. As we said, these were outliers, and why were they able to just keep going? Why did SVB, how could it have grown as quickly as it did and not have a chief risk officer? It just seems like there were pretty extreme situations at these banks. And I know regulators in Congress, we're all looking at this and the media, but just seems like there should be much more scrutiny of that and how happened.
Yeah, no, Maureen, I think that's great. And before you answer your part, Ryan, I just want to reemphasize that, Maureen, because we talked about it before and you've said a couple of times, it is interesting. Objective view would say that from a regulatory viewpoint and a follow-on viewpoint with capital and the like, the banking system is in a better spot. But to your point, there's still some obvious things that might violate the letter or at least the spirit of the change and attentiveness, and we're not attended to, right? And that's a pretty good use of a magic wand, which is pay attention to things that we know are a problem, or at least we're a close cousin to what we know are a problem. Be a little creative and be more responsive. I think if that's a fair summary, I think that's actually a fair magic wand. I know we by human nature tend to chase the last crisis, but as they say, history maybe doesn't repeat itself, but it rhymes. So we should be chasing the rhyming next crisis. So appreciate that very much. Ryan, you get a final word on this as well.
Well, I think if I had a magic wand, what I would say is in the last 15 years or so, there has just been an avalanche of regulatory burden placed on banks of all sizes. So the development of the CFPB has separated consumer protection from safety and soundness, but safety and soundness is the foundation of consumer protection. And I feel like there has been a distraction from that as banks have been forced to deal with more and more consumer protection regulation that, you know, is very well intended and very, you know, and in many cases necessary. I would say let's blank sheet of paper this. This is not complicated. We can develop a regulatory scheme that both keeps institutions safe and sound and consumers well protected. It's gotten too complicated. I think it just needs to be simplified.
I've just had an insight into what successful lobbyists and, you know, trade association leaders need to have, and it is a persistent sense of optimism, right? I think that makes you both good at your job and keeps you happy as a human. It makes perfect sense. I don't think I fully realized that until now, but I mean, that's a great, I appreciate that comment. And if you wed that up with Maureen's view, I think we'd be in a lot better place. Well, we have managed to hit a lot of different points in a fast changing scenario, which I think will leave everyone, you know, moderately satisfied as to getting some good info, but wishing that they had more, which is, I think, the best that we can do in this circumstance. And I just want to thank you both for your time. And I'll disclaim, none of what we said was investment advice. Very bad to take investment advice from any of us, obviously, but I do think it was very helpful to get some thoughts and enlightenment. So with that, I thank everyone for taking the time to participate in the webinar. Certainly feel free to follow up with Maureen if you've got any great insights. And if you know the way to the heart and mind of any given legislator, call Ryan. He could use that as well. He'd love that. He'd love that as well. And we look forward to seeing you at future webinars. Make sure to go to svdx.org to take a look at all the videos and things we have to offer. And thanks again to our panelists. Thanks, guys. Appreciate it.
Thank you.